Hey everyone, I'm Jeremy Szafron. This is Kitco News. We got lots to get to today. The global markets are reacting to multiple key developments. In the U.S., while job numbers came in strong for September, adding 143,000 jobs, wage growth is slowing and consumer debt continues to rise, particularly with credit card debt hitting all-time highs. And over to Europe, the European Central Bank is signaling that an October rate cut could be on the table as inflation falls below 2% for the first time in 3 years. However, inflation in core areas does remain persistently elevated. And on the geopolitical front, tensions between Iran and Israel have escalated sharply after missile strikes this week. Now, oil prices have surged above $70 US a barrel, and analysts are warning about a potential disruptions in global energy flows, particularly if this conflict spreads. Our next guest, Daniel Lacalle, is the chief economist at Tressis. He's also a well-known international economist and author, and he's been a critical voice on global inflation, central bank policy, and his macroeconomic risk. Daniel, thanks for making the time. Welcome back to Kitco News.
Thank you so much. Always a pleasure. Thank you for having me.
Of course. Okay, well, let's stick to the U.S., and then I want to go across the pond over to where you are. But first, given the complexities we're seeing in the U.S. economy, we got jobs being added, but wage growth slowing, and then we got debt rising. So what do you make of all of this? Is it a sign that underlying economic issues are being masked by these headline figures?
Absolutely. I think that when we look at macro figures, headline data looks relatively robust, but it's mostly disguised by a very significant accumulation of debt. And it's very typical of periods of risk accumulation in that many analysts say, well, nothing is happening, everything is strong, therefore there is no risk. Well, risks are building slowly, and they tend to manifest very quickly. So right now, it's very concerning, at least, to see that, for example, the headline GDP, the headline employment figures are actually strong, while at the same time we see weakening in real wage growth, weakening in job creation, and a worsening of consumer spending in an environment of much higher credit card debt. So all of these are little things that show us that maybe we will not get into a recession, but there's certainly a very discernible slowdown that needs to be addressed.
Yeah. Well, while consumer debt is rising, particularly with credit card debt at these record highs, some argue that the resilience in the job market could indicate that the economy, that's capable of maybe maintaining growth without overheating. Do you think that this debt buildup is manageable if the job market remains strong, or is it more of a ticking time bomb at this point?
Well, the debt accumulation is obviously less problematic while there is a strong labor market, but that doesn't make it easy or manageable. It's less problematic, and there's a big challenge there, is that policymakers tend to look at a relatively strong labor market with the perspective that then nothing is going to happen. But the strength of the labor market is not a leading indicator, it's a lagging indicator. It's showing us what has happened. It's showing us what has happened, not even today. It's showing us what has happened in the past month, no? So what ultimately we need to pay attention to is the fact that a number of things are sort of coinciding. On the one hand, consumer spending is slowing down. On the other hand, credit card debt is rising to new all-time highs, while labor market is weakening, even recognized by the Federal Reserve, in an environment in which the Federal Reserve of Atlanta, for example, is revising upwards GDP growth. So you see a significant discrepancy between the headline aggregated sort of national macro figures and the reality of consumers and small businesses, which is significantly more challenging.
Yeah, we look at those headline figures and we start to get into the inflation data. A lot of it looks like the fact that, oil prices have come down. The U.S. has certainly put the pumps on in that country, and there's a ton that's brought the gas prices down. Is it still sticky in other areas? We always hear from viewers, okay, you're reporting on inflation being down at 2.5%, but it still hurts out here.
Of course it hurts. First, because every consumer in the world knows that inflation is accumulative, so it doesn't matter if inflation is falling to 2.5%, because that means 20.5% in the past 4 years. So obviously that means 50% increase in gas prices, 30% increase in electricity prices, 23% increase in rents, etc., etc., etc. So ultimately, what is happening right now is, yes, we are seeing, and rightly so, because monetary aggregates have been declining. What we are seeing is that inflationary pressures are easing. But that doesn't mean that the non-replaceable goods and services, those things that we just simply cannot stop purchasing because we need them for our day-to-day lives, those things continue to be very, very expensive and rising. That's why almost every economist actually pays more attention to core inflation than to headline inflation. And I always say that when you see that headline inflation is lower than core inflation, that is basically telling you that citizens are not feeling any better. Furthermore, in the United States, at least, you get a full transmission of lower oil prices to the pump. In the European Union, you don't get any of that. You see the reduction in CPI from the energy component because crude oil prices are down, but people are not paying that same reduction in prices at the pump, no?
Well, let's break open that little oil package then. I mean, like you said, it's much different in Europe than it is in the U.S., but then we see these escalating tensions between Iran and Israel. What do you think the broader implications of this on global inflation could be if something drastic does happen?
Well, Jeremy, you just mentioned that the biggest component of the disinflation process in the past 12 months has been the reduction in the energy component. What has happened with the escalation of the conflict in the Middle East is that oil prices have round-tripped back to almost zero in the year. No, they were down 7.5%. And now basically WTI is flat relative to the beginning of the year, and Brent is down about 3%. So what we are seeing is that sort of tailwind for disinflation, that incentive for disinflation may be coming to an end, because geopolitical risks may not increase the price of oil to extreme levels like the ones that we saw in the past. But they certainly put a sort of floor on energy prices, considering that it is much more challenging to transport oil, it's much more challenging to move goods and services. And that there's a second derivative to this, is that we talk a lot about oil, which is the most important driver of reduction in inflation in the past months. But we also have to remember that copper, aluminum, and other very important commodities for the industrial complex are also rising. And this is coming when almost 20 central banks all over the world are cutting rates at the same time. So it's going to coincide that we get the negative impact of geopolitical risks creating a floor on energy prices, while at the same time you may get the incentive to take larger long positions, larger margin calls, larger exposures on the curve for commodity traders.
Okay. So, I mean, we had somebody on just recently that said, hey, this commodity super cycle is just beginning. I mean, are you of the same kind of belief here? Do you think this is going to be a more sustained going into these, cracks with the global economies around the world? Do you think there's going to be more of a sustained commodities run?
I would be very, very cautious about the word commodity super cycle, because I am 100% sure that the expert that mentioned that term had a very detailed analysis of it, but most investors think that it's basically they will go up forever, no?
Yeah,
And that doesn't happen.
Yeah. Yeah.
The commodity super cycle is actually very much in place because we are seeing a very aggressive negative impact on investment. The underinvestment in energy is enormous due to the uncertainties about global policies, about climate change impositions, and all these things. The underinvestment is enormous. I think it's the largest seen in industrial history. And at the same time, what we have seen is that many of the energy policies of developed economies have backfired, and there is a growing demand for even commodities that we almost forgot in our debates, like coal. No, Germany now is consuming more coal than they did many years ago. No, so demand is structurally robust, and supply is getting tighter because of the environment of underinvestment. That doesn't mean that commodity prices are going to go through the roof forever and that you just have to go and take the carry trade, because at the same time, the monetary spectrum and the manufacturing weakness put a lot of brakes on price appreciation. So what I think that is that you need to be very aware of the differences between the long-term structural elements that drive supply and demand, which I completely agree of the super cycle, relative to just prices going up on and on without control. Because we also have to remember that demand so far remains relatively robust thanks to the fact that commodities are not rising dramatically. When they rise too fast because of inflationary pressures, then demand falls abruptly, creating a crisis. So I think it's basically just more of the slow motion process in which the reality of underinvestment coincides with the inevitability of a level of demand that is very unlikely to dramatically decline from where we are today.
Yeah, interesting. And as you said, obviously we have elections. There could be some policy changes going forward. We're really in this kind of sit back and wait period. But Europe hasn't been. I mean, the ECB has signaled that an October rate cut is likely. Inflation has dipped below 2% for the first time in 2 years. Do you think that this is the right move? I mean, given the risks of core inflation remaining high in some of those sectors?
Well, I think that it's very risky because we have to remember that higher for longer lasted less than 18 months in the United States and less than 15 in the euro area. That means that we have seen the lowest period of tightening in an inflationary burst since probably the breakup since the Bretton Woods trade agreement. No, so. The danger here is that the ECB acts way too fast, way too aggressively, way too quickly, and then makes a policy mistake. Because if you look at the latest euro area figures, the entire disinflation process has come from energy, all of it. And in the case of the euro area, it's been due to two factors that are different than in the United States. Number one is the natural gas prices have declined very, very fast in international markets, despite the Ukraine war and all these things, because of the different avenues of supply that have arrived into the European Union. But basically, due to the second factor, is that we had an exceedingly mild winter in 2023, exceedingly mild winter in 2022, and therefore the level of inventories is very high. Now, it only takes a colder winter or a disruption in the very, very ample flow of natural gas from other economies, for example, from the United States. The United States may stop delivering into the European Union and focus more on domestic demand now that prices, Henry Hub prices, are actually higher. So the European Central Bank doesn't seem to look at those things. The European Central Bank looks at headline inflation, core inflation, says, It's closer to target. Let's cut 50 basis points and then another 50 basis points. Well, there's a danger to that. There's a very strong danger that the inflationary reduction meets the increase in money supply, the rate cuts, and a change in the energy landscape to show that the ECB was too aggressive, no?
Yeah. So, I mean, if this happens, Daniel, I mean, if core inflation doesn't recede, are they not going to face stagflationary environment like we've seen in the past?
I would argue that a lot of euro area countries are in stagflation already. Because remember that we discussed the aggregated average euro area CPI, Consumer Price Index. But in that below 2% that you just mentioned, there's a few countries that have more than 3%. There are a few countries that are way above 2%. No? It's basically just that the disinflation process in France and Italy, which has been much faster because the economy is not doing very well, is, let's say, disguising that. Therefore, what you have is between 6 to 8 countries that have plus 2% inflation, headline inflation, and significantly higher core inflation with a level of economic growth that is between 0.3 and 1%. That basically is stagflation to me. I also would argue that even if we look at the aggregated euro area figures, even in the countries that are allegedly growing fast, you see, for example, Spain growing at 2.5%, but inflation is significantly higher than in the euro area, and core inflation even more so. So I think that all of those factors show that the risk of stagflation is it's actually a reality in many economies.
Yeah, I mean, we're certainly seeing that slowing growth in places like China. I mean, they came and put a lot of stimulus into the economy. We've been watching their stocks go crazy this past week with that stimulus. Then they have their real estate challenges. I mean, are they seeing what we're about to see?
I think that what China is basically proving to the world is, number one, that you cannot address the challenges created by misguided stimulus packages with more stimulus packages. So at least what China has done, and I think that that's why the market has received it so positively, is to target it to supply side measures. All of them are actually improvement in access to credit. There is no sort of government building stuff for the sake of building things. So I think that that is an important factor. I think that also China is showing that when you have a chain of stimulus plans like the euro area is following, and like China followed in the past, overcapacity is almost inevitable and leads to stagnation in the case of the euro area, in the case of China, to a very solid 5% growth, but obviously significantly below what they were growing at in previous years.
Yeah, I mean, it's such a global economy, it almost feels like, that we feel the pinch between country to country. Do you think that China's internal economic struggles will lead to a larger global repercussions?
There are some repercussions already. We have seen how China has become less of an importer. That has also helped many developed economies. China is importing a lot less commodities than it used to because of the slowdown. That has been a positive for us, because the prices of those commodities have declined. But we have also seen the negatives. We have seen the negatives in the very important exporting machine of Germany that has lost one of its major markets, almost, I wouldn't say not lost it, but lost the momentum of one of its major exporting markets. Many emerging economies that were basically betting on China growing significantly above the 4% level with the reopening are finding themselves with many goods that are not being sold to the Asian giant as they expected. So yes, absolutely. You've said it perfectly. This is a global world. There is no such thing as a slowdown in China that is not going to affect other economies, no?
Yeah, exactly. But I mean, you mentioned, I mean, there's significant player in commodities, and this slowdown, could it actually ease some of the inflationary pressures that we're seeing globally as well?
Absolutely, absolutely. And we should thank the slowdown in China for the disinflation in energy that we mentioned before in our conversation. Because if China had been growing at 7% and importing and mostly growing its imports as fast as they were prior of coal, copper, aluminum, oil, etc., today the euro area would not have below 2% inflation, and the United States would not have a disinflation process like the one that we're discussing. There would be more than persistent inflation. Yes.
Yeah. Well, I mean, in light of these global challenges, I mean, like you said, we got the rising debt, this geopolitical risk, central bank uncertainty. Where do you see the best investment opportunities? Is it still safe havens like gold? You mentioned that it's, commodities are very cyclical. Are you looking at other areas here?
I would certainly take a dip into commodities short term because of the positive impact of the stimulus plan in China, plus the geopolitical tensions. But I would take it as a trading opportunity more than a long-term only bullish cycle. I think that the process for commodities is very choppy and will likely continue to be so. So I would certainly look at commodities. I would certainly continue to be invested in gold. I think that gold is basically discounting the level of monetary destruction and the level of monetary easing that we are seeing and likely to see in the future. And I think that the market is right by every time that there's a dip due to geopolitical tensions, due to the carry trade in Japan, etc., to look at the United States stocks and buy into US stocks, because those are the ones that discount better and that give a better protection against the massive increase in money supply and the risks of reducing the level of growth in other economies, because these are such global companies in the S&P 500 that you have technology giants that will continue to grow at double digit, even if there is a contraction in Germany or a slowdown in China.
Yeah, interesting. Daniel, you looking at hard assets at all? I mean, we hear about how the real estate sector, for instance, is going to crash. Would you be looking at some of these haircuts, buying some of these dips? You think we're going to go into a phase here where maybe hard assets is key?
Oh, absolutely. If somebody out there is fearing a crash in real estate, they should look at it from the perspective of buying like there's no tomorrow. First, I don't think that there will be a crash. We're in a very different position than we were in 2008 in terms of debt, in terms of margin debt in particular, and in terms of the level of accumulation of risk. But more importantly, because at the end of the day, hard assets are not better investments because they're more safe or because they're better, but because they are the ones that capture in the essence of the level of debasement of the currency that we use every day. No, so I think that real estate looks very, very positive on a long-term basis in all developed economies, and particularly in large cities. I think that obviously you have to be nimble and you have to look at fundamentals properly. But I also think that it's important to think of hard assets, for example, in mining. No? I find that it's incredible to see the enormous level of underinvestment that we discussed prior, and the incredible demand that there will be for copper, for rare earths, for lithium, for oil, for gas, etc. And I basically think that you will certainly need a lot of investment there that is going to drive hard asset prices higher. And actually, if you want to play that commodity super cycle that we were talking about, you're probably better off in the non-quoted world and in the sort of services or exploration side than in the sort of quoted large cap stocks.
Yeah, it's fascinating. I mean, specifically, as you mentioned, because we kind of went through this energy transition trade already. It feels like everything ran up so fast, and then we had this rebalance. I guess this one's going to be different.
Well, I think it is going to be different because this is the first energy transition in history that has been politically designed and has not thought at all about the requirements of mining. Now, all energy transitions in history have happened via the adaptation of consumers to the reality of the resources available. This is an energy transition in which some politicians have designed, we're going to get here in 2030 without thinking that we need 60 times more copper mining to do that than we have currently in place. So obviously that basically, every time, as it may sound, a little bit ironic, but if you hear governments say that by 2030 we will not use coal, oil, or gas, you should invest in coal, oil, and gas like there's no tomorrow.
I hear you. I've been told that before. Okay, I appreciate it. Daniel Lacalle is the chief economist at Tressis. Very good to have you on, my friend. We'll continue to watch what's happening, and after we get a couple of nods from the political side of things, where things will end up, we'll have you on for a little update. I still find it fascinating that on the U.S. side, either of them that are running for president are not talking about debt.
Oh, and they won't. And they won't. Because it's a trend that is very worrying all over the world. We've had more than 70 countries with elections in 2024, and none of the candidates in those debates have been talking about debt accumulation or balancing the budget. Everybody seems to think that money is free. And when people think that money is free, what we tend to forget is that means that money will be worth a lot less very quickly. So that is a challenge. One thing that I found interesting, at least, was to see a very surprising promise in the Republican side of maintaining the dollar as the world reserve currency, which is a sort of roundabout way of telling you that they acknowledge the fact that continuing to deficit spend and continuing to print money may put that US dollar at risk. But I would like to see what that actually means in terms of direct and concrete policies, no?
Yeah, I mean, we weren't going to go down there, but as I have you, Daniel, what do you think it would like? I mean, you're talking about Trump basically coming out and saying, I see this is happening and I promise to get it together. But what's the plan there? I mean, what can actually be done?
There's only two things that can be done, and one doesn't compute. It doesn't work. One is you need to cut spending. I mean, it's ridiculous to believe that the Treasury itself assumes that there will be a $16 trillion increase in the national debt between 2024 and 2034 with no recession, no weakening of the labor market, and record tax revenues. That already shows you how unsustainable the debt situation is. So one, you need to cut spending, and you need to do it efficiently in a way that makes discretionary spending at least offset the impact of the inevitable rise of mandatory spending. So that's one thing, but it's not enough. It doesn't even start to address the problem. You need to implement very aggressive pro-growth policies. You need to implement measures that will bring much more investment into the United States, much larger companies into the United States, support the growth of the small businesses so that they become large businesses. you basically need a it's called pro-growth, but I call it pro-wealth strategy, because that basically means increasing the demand for US dollars in an environment in which even if you cut spending, you will not start to fully address the deficit problem.
Yeah, interesting. Well, at least one of them's talking about it, and it's not going to be, hopefully, my children having to deal with all this future debt. Daniel Lacalle, Chief Economist at Tressis, joining us today. Thanks again for making the time. Hopefully, it's not yours either.
Thank you so much. It's a great pleasure. I enjoyed it.
Thanks, Daniel. I'm Jeremy Szafron with Kitco News. For all of us here, thank you for tuning in. We got some great content coming all week long, including some important economic data we'll bust into, and of course, next week too. Stay tuned. We'll see you next time. Thanks for watching.